Want to invest where the world is heading? Sector investing lets you do just that. In this video, we're breaking down sector investing, betting on the future of tech, healthcare, and AI. You'll learn how to target fast-growing industries, manage risk through diversification, and position your portfolio to ride the next big wave of innovation. Today, we will talk about sector investing, betting on the future of tech, healthcare, and AI. So before we get started, make sure to hit that like button, also subscribe to my channel. Sector investing focuses your money on industries with high growth potential. When most people invest, they spread their money across the entire market. That includes companies in all industries: energy, retail, banking, and more. But sector investing is different. It means putting your money into specific parts of the economy you believe will grow faster than the rest. For example, you might believe that healthcare is about to explode due to aging populations, or that artificial intelligence will change every industry it touches. By investing in sectors, you're not just buying stocks, you're backing trends. This focused approach can deliver bigger gains than broad index investing, but it also comes with higher risk. That's why understanding the sectors you invest in is key. 2. The tech sector has been a growth machine for decades. Technology has been one of the most dominant sectors in investing history. It's driven by innovation, speed, and scalability. Think about the rise of personal computers, smartphones, cloud computing, and now AI. The biggest companies in the world today, like Apple, Microsoft, Amazon, and Google, are all tech giants. They created massive wealth for investors over the past 20 years. But tech isn't just about big names. It includes startups building new platforms, cybersecurity firms, chip makers, and software-as-a-service businesses. The tech sector is constantly evolving, which means it continues to offer new opportunities for smart investors who want to ride the wave of the future. 3. Healthcare is growing because the world is aging. Healthcare is another sector with powerful long-term growth potential. Populations in many countries are getting older, and older people need more medical care. That means more doctor visits, surgeries, medications, and health services. At the same time, technology is improving how care is delivered. Companies are building wearable health devices, robotic surgery tools, and personalized medicine based on genetics. There's also a big push to lower healthcare costs through innovation. Investing in the healthcare sector means backing companies that provide essential services, and that demand isn't going away. Whether it's biotech, insurance, hospitals, or pharmaceuticals, healthcare remains one of the most stable and future-focused sectors. 4. Artificial intelligence is transforming every industry, not just tech. AI used to sound like science fiction. Now it's real, and it's everywhere. Artificial intelligence is being used in finance, education, medicine, transportation, and even farming. That means AI is not a single industry. It's a tool that's reshaping every other sector. Companies that develop AI software, build the chips that power AI, or create AI tools for businesses are becoming the new leaders. By investing in AI-focused companies, you're placing a bet on how fast this transformation will happen and how deeply it will change the world. This makes AI one of the most exciting and fast-moving areas in sector investing today. 5. Sector ETFs make it easy to invest in these industries. You don't need to pick individual stocks to invest in a sector. Sector ETFs allow you to buy a whole group of companies in one industry with a single purchase. For example, if you believe in healthcare, you can buy a healthcare ETF. That fund might include drug companies, device makers, insurers, and more. The same goes for tech, AI, energy, or any major sector. ETFs are simple, low cost, and give you instant diversification within that industry. You don't have to guess which company will win. If the entire sector grows, your investment grows. That makes sector ETFs one of the easiest ways to take advantage of industry trends. 6. Timing matters more in sector investing. One thing to understand about sector investing is that it's not always safe to hold forever. Some sectors do well during certain parts of the economic cycle, while others struggle. For example, tech stocks might soar during boom years but crash during downturns. Healthcare might stay strong during recessions because people still need care. That's why timing can play a bigger role in sector investing than in index investing. You need to pay attention to economic conditions, interest rates, and even global events. That doesn't mean you need to trade constantly, but it does mean sector investing rewards those who stay informed and think ahead. 7. Concentration can lead to higher returns or higher losses. When you invest in a specific sector, you're concentrating your money. That can lead to big gains if you choose correctly, but it also means more risk. If that sector performs poorly, your portfolio can take a hit. For example, energy stocks may underperform during oil price crashes. Tech may fall if interest rates rise sharply. This is why many smart investors combine sector funds with broad index funds. That way, they still get overall market exposure while targeting high-growth areas. Sector investing works best when you use it as a focused part of your larger strategy, not your entire plan. 8. Research is essential when you invest by sector. Because sectors move for different reasons, you can't rely on one-size-fits-all advice. You need to understand what drives each industry. For tech, it might be innovation and product cycles. For healthcare, it's government regulation and scientific breakthroughs. For AI, it's computing power, data access, and adoption across businesses. Before investing, study the trends, the key companies, and the risks. Read earnings reports. Follow news about regulations and technology. Sector investing gives you more control, but that also means more responsibility. The more you understand, the better decisions you'll make. Informed investing always beats guessing. 9. Younger investors can take more advantage of sector growth. If you're in your 20s or 30s, time is on your side. That's one reason younger investors often lean into sector strategies. You can afford to take more risk for higher reward because you have years to recover from setbacks. Tech and AI, in particular, are sectors that may take decades to fully develop. Early investors often benefit the most. By starting early, you can ride long-term growth cycles and compound your gains. Just remember, long-term doesn't mean ignore it. Stay involved, stay educated, and adjust your strategy as needed. 10. Sector investing is about vision, not just numbers. At the core of sector investing is a belief in the future. You're placing bets on what the world will look like 5, 10, or 20 years from now. Do you believe electric vehicles will take over the roads? That biotech will cure diseases we can't treat today. That AI will become a basic tool in every business. These aren't just investments, they're convictions. Sector investing is about more than charts and price movements. It's about identifying trends, understanding human needs, and trusting that some parts of the economy will grow faster than others. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.